Mike Leamy. I've been teaching business classes here at the school for 3 years. I am going to walk you through what could be considered some advanced topics, right? But we're going to start with accounting. We're going to look at a very specific accounting issue. I'm going to take you through the accounting equation, talk to how that gets to financial reports, and then we're going to talk about budgeting and how this all comes together. Anyone think I can actually do it in 20 minutes? And make sense? All right, we're going to see how it goes, right? The key of what I want to say here is that literally as a small business owner, you're probably not going to be an expert in all these areas. You might hire an accountant. You might hire someone to help you with the financial piece. Probably going to hire someone in your area with a little bit of law and legal knowledge, right? But it's important to have a general understanding of how all these pieces come together so that you can be strategic and hopefully successful in the short term and in the long term. So with that in mind, we're going to start with accrual versus cash accounting. So pretty straightforward. I said they're advanced topics, but we're going to look at them in a very specific light and time altogether. So accrual-based accounting says that you are going to do accounting transactions. We're going to record income when it's earned, and we're going to record expenses as they're incurred. Pretty straightforward, right? Versus on cash, we just record the transaction when the cash changes hands. Pretty straightforward in terms of which one's going to be more accurate, right? If you want to know what's going on at a specific time, you're going to want to look at accrual-based accounting. Why is that the case? Well, in this example, again, super simple and straightforward to kind of make the point. We're looking at a consulting firm. They complete a project in December, but they do not receive payment until January. They have earned their income in December, right? So we want to have accrual-based accounting so we know that. In cash-based accounting, or if you're not aware of this situation, right, you're sitting in December, and let's say January bumps out to February. It's a long gap between when you actually earned your income and when you're recording it. Not ideal, right? Stay with me just on that thought, and we'll circle back to why cash is important. It has to do with solvency and liquidity. Solvency being the ability to pay debt as it becomes due, right? All right. So the accounting equation, I am going to admit, right, I said for like a decade I was a financial accountant before getting into higher ed. So I like this stuff. I know for the average person, it's not super exciting. Bear with me, this slide will be quick, all right? Just by show of hands, so I have an idea. How many folks have taken an Accounting 101, Introduction to Accounting? All right, keep those hands up. How many people hated that experience? All right, that's about what I thought. If you're watching the video, not a whole lot of hands went down. So I am going to tell you that in almost every accounting class, you're going to see assets equals liabilities plus owner's equity. That's the accounting equation. I'm going to walk you through really quickly why I teach it a different way and why I think it's important to understand, especially as a financial person or a business owner or someone just trying to understand how the books are going to impact what you do. So, simple math. What I do to one side of an equation, I can do to the other one, right? That's not even accounting, that's algebra. So if I want to subtract liabilities from each side, I end up with assets minus liabilities is equal to owner's equity. Fair? All right, I'm going to also tell you that another form or another way to account for owner's equity is capital plus income minus expenses. Assets are what you own, liabilities are what you owe. Capital is what you've put into a company, right? Income is what you've earned. Expenses are what you need to pay out. So why is all of this important? And why is the bottom the equation that I teach? Transitive property. Does everyone remember that? A is equal to B, B is equal to C, A has to be equal to C. So assets minus liabilities is equal to owner's equity. Capital plus income minus expense is equal to owner's equity. Therefore, we end up with assets minus liabilities is equal to capital plus income minus expense. All right, I know the question is, other than Mike, you're kind of a math nerd, why are you telling us any of this, right? Nobody really wants to hear that. Bear with me. What it's going to do is it's going to impact your financial statements. And again, don't expect you to memorize all of this. We have a series of handouts. They're here up in the front. We'll make sure that everyone gets one as you're leaving out. Terms are in here, some of the definitions, and an example that we'll walk through later. So don't feel like you have to write anything down. Just sit back and listen. Enjoy as much as you can. All right? Key financial statements, and we're going to breeze through these a little bit quicker. Again, by show of hands, how many people have heard of these three financial statements? Almost everybody, right? All right, so we have a balance sheet, income statement, statement of cash flows. Everything we've talked about to this point directly ties into this, okay? So I'm gonna work backwards. Your statement of cash flows. Statement of cash flows is really important because you need to be able to pay debt as it comes due, right? If you're the owner of a small business or if you're the manager of a department, you need to know when you have access to be able to pay bills, to invest, just to move cash around. Good with that? Balance sheet and income statement. Has anyone heard of a general ledger? Awesome. So some people do recall stuff from accounting. That's a good sign, right? General ledger is there's a front sheet and a back sheet. Do you remember they have to be equal to each other? All right. So your balance sheet, front side, assets minus liabilities. Income statement is your capital plus your income minus expense. Everything ties back to that owner's equity number. It's what's left over when all's said and done. But for us to be able to make sound financial decisions, we have to be able to look at these statements, but also understand how these statements are impacted by the transactions that take place. We buy and sell something. We have to pay our labor. All of these things are transactions that take place that, as a small business owner, you're often caught up in the idea, right? You have a great idea. Professor Devlin talked about how you protect yourself. Professor Colby Clement talked about hiring and firing people. But way before that, you at one point probably had an idea or something that was a passion and inspired you. You have to be able to operationalize that. All right, so where are we going with this next? Advanced budgeting techniques. So there are a ton out there. I had originally added to that handout a list of all the different ways to go, and I decided a cleaner and easier way to talk about it was just zero-based budgeting. All it is you start with nothing and you justify every expense that you need in order to be able to run your business. So for example, my son was washing cars to make a little bit of money. Being surrounded in our family by lawyers, I was like, listen, because of liability, you're only washing cars with people that we know. We'll see how that goes. But, you know, we talked about here's what you need. You need, dad was at least a nice dad, so I let him have water and towels and that kind of stuff for free, right? But he had to go out. If he was building a budget, he had to at least go buy soap, a sponge, the different things he needs. So in that scenario, a zero-based budget, he's just buying up supplies that he needs, right? All right, variance analysis is when you look at how your budget operated. So you budgeted for X. At the end of the day, Y comes in. Are you high, are you low, and why? It's a simple, simple concept, but so often not done, right? Folks just move forward. It's like a checkbook. A lot of people don't balance their checkbook. They just assume it's right. That should be a session we do sometime here, right? That's just mind-boggling to me. I don't imagine I would be able to sleep at night if I operated that way. But some people do, all right? And I'm not judging anyone in here if that's the way you operate. You do you. But I would strongly recommend my financial literacy class here at the college. All right, so variance analysis just means you go in and you take a look at that. So a really simple example is a manufacturing business, budgets $15,000 for materials, they spend 18. When they did their analysis, production demand increase, so they had to create more. Not necessarily a good or a bad problem, right? It's just a variable cost that went up. But if the cost of the material itself just went up, that's a different scenario that we want to be able to take a look at. We're going to get to that, because to me, that's where really you're going to make your decisions. So far, so good, right? We've gotten through accounting. We even talked about the accounting equation, and Mike walked you through his fun math to make it more understandable to financial statements. Talked about the financial statements, and everybody's still alive and doing well. All right, we're good. Break-even analysis. This, to me, is where we're going to take just a little bit of a deeper dive. All right, so again, by show of hands, because clearly tonight, this is what I like to do. How many folks have heard of break-even analysis? All right, not as many hands as before, and that's okay, right? It's kind of a financial, operational way to strategize and to make decisions. It does everything from setting prices to trying to figure out what your demand, what you're going to need. First, it's we calculate the point where revenue is equal to total costs. All right, so what break even means is we know how much money we're spending to produce something. how many units of this something do we have to sell in order to at least break even? We're going to talk about why that's important. It's useful for determining pricing and sales targets. All right, so but before we can do all of that, we have to understand how business expenses work. I've thrown a lot of different things out at you tonight. In the handout, I walk through all these different categories because in a nutshell, when you read them at first in the slide that's going to come up, it's really straightforward and simple. The way some organizations represent them, as opposed to what shows up on your financial statements, can be confusing. So everything is spelled out for you. You have access to the decks. I'm going to walk you through this so we can get back to that break-even analysis and why that's all really important. Sound good? So understanding business expenses, we have two major categories. Cost of goods sold. And the reason I talk about cost of goods sold versus operating expenses here is because that's what's listed on financial statements. Okay? So cost of goods sold are direct costs tied to production. Fair enough, right? An example is raw materials. Doesn't get any more specific and easy to follow than that. I feel like every business class I was in, they were making widgets. I'm 48 years old. I was at Bentley when I was 18. That's 30 years later. I still don't know what the heck a widget is. But we're going to go with widgets, all right? So I'm buying wood to make these widgets. Raw materials, pretty easy, I know. I need that. That's a direct cost. Easy, right? Operating expenses are ongoing costs, like rent, utilities, not directly tied to it. All right, those are the things that you are going to see on financial statements. How do we apply that so we can make sound business decisions in the operation? Well, we want to know what direct versus indirect costs are. I'm going to say 90 plus. I used to say 99%, but it's not. 90% of the time, or better, direct costs are really your cost of goods sold. They are easily linked to the manufacturing of that unit, okay? An indirect cost is almost always operating expenses. It's other items. I had originally had a slide in here that talked about where there could be some discrepancy. Felt like that made it more confusing. So we're just going to stick with this for now. Does that all make sense? Well, that's good, because now you got to move on to two other costs, which is how we actually do break-even analysis. And they get a little bit more complicated than these. These are directly tied to your financial statements. There's a link to the next two costs that are coming. But I wanted to make sure we're comfortable with where we are before we move on. Fair? All right. So I didn't put them on the slide. They are on your handout. They are fixed and variable. Just by the name, that's why they're not on the slide. Fixed means they do not change. Variable means that they do change. They go up as you create more. They go down as you create less. Fixed and variable just by definition, right? All right, so why is all of that important? The break-even formula is your total fixed cost. A lot of times it's looked at as operational cost, marketing, things that are done outside the production, okay? You're going to take that total fixed cost and you're going to divide it by price per unit, selling price, minus variable cost per unit. All right? Another term for that is contribution margin. Your contribution margin is how much of a profit you make off of the sale of each unit. To me, as someone who's selling an item, break-even analysis is, I say this a lot, listen, I'm going to pick on you a little bit in class. I always say, right, if you're going to take one thing away from class today, take this. This is a slide that I would focus on. All those other things are important and they all tie together, but when you're trying to look at pricing strategy and getting to a certain profit level and how that all impacts, this is really a pretty simple concept that is so often overlooked. All right? So, for example, if we have an item that sells for $100 and the variable costs are $60 per unit. I know I said I'd like math, right? 100 minus 60 equaling 40, that's not hard math. So I didn't feel like we have to have too much further of a conversation about that. But it's simply your selling price at $100 minus the cost, the variable cost per unit gives us $40 a piece. All right? So now we know that we have a contribution margin of $40. So all we have to do is then find out what are all of our other costs, right? It could be the cost for the building. It could be if we want a fancy espresso machine. I like coffee, so that would probably be something I'd be guilty of, right? Those total fixed costs are important. Going back to budgeting, someone should probably overlook and not let me buy that espresso machine when we're getting started, but if it keeps me motivated, maybe they're there. Trade-offs, right? That's the fun part about what makes your passion. All right, so we have our total fixed cost, and in this example, $20,000. So your break-even point here is 500 units. You take $20,000 divided by $40 profit per item sold, and it gives you 500 units that need to be sold. With a clear understanding of cost structure and break-even numbers, companies can set prices for their products, cover their fixed and variable costs, and provide a reasonable profit margin. I put that in to walk you through what the final thought is. What's also going to be in the handout that you look at tonight. I figure I've manipulated enough formulas to show you different features of how you can use them, that there are examples for break-even units. You can do it in dollars so that you know how many units will equal this number of dollars for a net to be zero. But then you can use the formula to start to plug in and say, all right, I know I need to make X number of dollars. You know, I hire a manager that's known for whatever, they're going to come in and they're saying, we need to make $100,000 this week, this month, this year, whatever the case may be. The way to be able to formulate and calculate how I'm going to get there is instead of plugging in zero as your break-even dollar or unit, you plug in the dollar amount of $100,000. Or if we're getting started, it could be $10,000, right? And then the calculations are all the same. You're just playing with what your goal is. So how does this all come together? If you apply these advanced accounting and budget techniques to improve financial decision making, right? Often people hear balance sheet, income statement, statement of cash flows, and look at the numbers, and it's super overwhelming. And you just don't want to deal with it because it's like math in general. People either love it or people hate it. And much more people hate it than the number of people who enjoy it. I'm lucky enough that I'm in the few that really likes it. Probably why I'm here talking to you all about it tonight. It allows you to understand and manage your business expenses to maintain profitability. If you are just setting prices kind of willy-nilly, not looking at what your budget is and going with the flow and saying, hey, this is great. I spent this much, I have this much, here's what's left over, and here's how I'm going to operate. Might be good in the moment, causes some real problems as you're trying to set strategy and move forward. But more importantly, at the end of the day, right, if we want to be able to incorporate, if we want to get investors, we're probably going to need to be able to show what the long-term vision is and how we're going to get there. And these techniques allow us to do that, which is using financial statements and break-even analysis to guide your strategy. So, make some sense? I would imagine there probably are some questions. I'd have to look and see how I did on the timing, but I think we were pretty darn close. If you have questions for that, please feel free to email them to me. I'm happy to answer and share what knowledge I do have.